Hey everyone, have you ever wondered why the financial decision made in Washington D.C. can directly affect someone's mortgage in Hong Kong? So welcome to our explain a recent headline, which is the Hong Kong cut interest rate, checking fake move. So here I'm Elijah, and today we are breaking down this complex financial story into simple, bite-sized pieces. We will explore how these decisions connect to major financial markets, the foreign exchange market and the mortgage market. So let's dive in. So what's actually happened? Recently, the U.S. Federal Reserve decided to cut its interest rate. Just hours later, the Hong Kong Monetary Authority, which is the HKMA, which acts as the Hong Kong Central Bank, announced it was cutting its base rate by the same amount. It's a mandatory move due to a unique system Hong Kong has had since 1983. The story is all about a powerful link between two places thousands of miles apart. So, the first and most important market here is the foreign exchange market, where currency are traded. Hong Kong dollars is pegged to the US dollars. Think of like the typing two both together, where the US dollar goes, the Hong Kong dollars must follow. This is our core cost concepts about the interest rate parity. To keep the peg stable, Hong Kong must align its interest rate with the US. If they didn't, investors would simply move the money to wherever they get a higher return, causing massive instability for the Hong Kong dollar. So this brings us to the second market, which is the mortgage market. This is where people borrow money to buy home. When the HKMA, the Hong Kong Monetary Authority, cut its base rate, it influenced the Hong Kong interbank's offer rate, the rate banks charge each other, and this in turn affects the mortgage rate offered to the home buyer as well. So let's look at the data. This chart shows the Hong Kong Monetary Authority base rate falling. So what's the impact? For borrower, for the borrower and the mortgage market, this is a great news. Lower rate means lower money mortgage payment. This can be stimulate the property market, making it slightly more affordable to buy a home and boosting demand. For saver, it's the opposite. They will earn less interest on their bank deposit. Now, from my critical perspective, did the market react correctly? In short term, yes. The forex market remained stable, which was the primary goal. However, in the long term, this creates a dilemma for Hong Kong. So, Hong Kong is essentially importing US monetary policy, even if it doesn't fit its own economic needs. If Hong Kong's economy was already overheating, this rate cut could overstimulate it and inflated a property bubble. This lack of the independent policy is a key trade-off for the currency stabilities and the pegs provided. So could there be a secondary effects? Yep, absolutely. Stock market. Lower rate can be positive for stock as company borrow and invest more cheaply. Bond market. Existing bond with higher rate become more valuable. Even cryptocurrency. Some investors might see it as a sign of loose global monetary policy, which can sometimes drive money into alternative assets like crypto. So, in conclusion, a single interest rate cut in Hong Kong is far more than a simple policy change. It's a story of the global connection, a necessary sacrifice of monetary independence for currency stability, and a decision that ripple from the foreign market right down to the monthly budget of a family with a mortgage. So it perfectly shows how intertwined our global financial system truly are. So the video is come to an end. Thank you for watching. See you guys in another video. Bye.